What if I told you the biggest problem in mobile insurance today isn't the claim, but it's how they're priced? Mobile insurance has always been a one-price-fits-all model, where everyone pays the same. But customers handle their devices differently, yet it's assumed that everyone's risk is the same. In reality, we know that just isn't true. We've developed a technology called behavioral intelligence. It uses real-world behavioral data, AI and machine learning to predict the risk of the user on their mobile insurance program. And this enables us to fundamentally change the pricing model. To understand how this works, real-world risk falls on a bell curve. Low-risk users on one end, high-risk users on the other, and most customers in the middle. That's what's expected. Now, overlay claims data. You'll see claims concentrate exactly where you would expect, on the higher side of the risk curve. That alignment between predicted risk and actual claims is what validates the model. There's no universal benchmark for this, but when compared to regulated industries like auto insurance, our predictive accuracy meets and in many cases exceeds those standards. Once risk can be predicted accurately, pricing no longer needs to be static. It can reflect the actual risk of each user. In a predictive pricing model, higher risk users are priced higher to reflect their increased likelihood of claims. Lower risk users are priced lower because their expected cost is lower. Importantly, this doesn't reduce margins. It actually aligns them. Each segment is priced appropriately for its risk, allowing margins to be maintained or improved across the program. And this is where the model becomes more powerful and no longer one-dimensional. As users are recognized through better pricing, their churn decreases and their loyalty increases. At the same time, more customers choose to enter the program because pricing feels fair. The result is a program that grows in two ways: higher retention from existing users and increased attach from new users. In practice, this translated into up to 22% growth in overall book size and up to 5% in attach rates. Naturally, the next question is about compliance. Can this technology and pricing be deployed into regulated markets? The answer is yes. We've developed a comprehensive data and actuarial framework to support the regulatory review and approval. This includes documented model performance, actuarial validation, transparent pricing logic. And we are actively working with partners across multiple jurisdictions to bring risk-based pricing into market in a fully compliant way. Beyond pricing, permission behavioral data also enables ongoing engagement, turning what was once a static product into a dynamic relationship with the customer. For partners, telecom providers, OEMs, retailers, and insurers, this isn't about replacing what works, it's about evolving it. In a market where products look increasingly similar, the ability to price based on real behavior becomes a structural advantage. The shift is already happening. Leading players are already working with us to move beyond the limits of static-based pricing models. This is just the beginning.